Hello everyone, welcome to weekly lecture videos. This week our topics are dividend policy and raising capital. We are covering two chapters this week, chapter 14 and chapter 15. So let's start with chapter 14. Um, this chapter is about dividend policy. And if you can recall from chapter 7, we saw that the value of a share depends on all the future dividends that will be paid to shareholders. In that analysis, we took the future stream of dividends as given, right? What we now examine is how corporations decide on the size and timing of dividend payments. What we would like to find out is how to establish an optimal dividend policy, meaning a dividend policy that maximizes the share price. What we will discover, among other things, is that it is not at all clear how to do this, and that it's even difficult to say if there is such a thing as an optimal dividend policy. Dividend policy is an important subject in corporate finance, and dividends are a major cash outlay for many corporations. At first glance, it may seem obvious that a firm would always want to give as much as possible back to its shareholders by paying dividends. It might seem equally obvious, however, that a firm can always invest the money for its shareholders instead of paying it out. The heart of the dividend policy question is therefore, should the firm pay out money to its shareholders, or should the firm take the money and invest it for its shareholders? Okay. Well, it may seem surprising, but research and economic logic suggests that dividend policy has yet to provide a definitive answer as to whether dividends matters. Okay. In fact, it turns out that the dividend policy issue is much like a capital structure question. The important elements are not difficult to identify, but the interaction between these elements are complex and no easy answer exists. Okay. So we will uncover these puzzles or answer to these questions in this chapter. So in this chapter, we will mostly talk about different types of dividends, how dividends are paid, and the dividend policy theories. We will also talk about cash and share dividends and also share repurchase as an alternative way of paying cash to shareholders. As usual, I will be uploading one video explaining each of these learning objectives. And in this video, I am mostly discussing dividend types and how dividends are paid. Okay, the term dividend usually refers to cash paid out of earnings. If a payment is made from sources other than current or accumulated earnings, the term distribution rather than dividend is used. Okay. However, it is acceptable to refer to a distribution from earnings as a dividend and a distribution from capital as a liquidating dividend. Okay, so I repeat that when cash is paid out from earnings, it is dividend. And when payment is made from sources other than current or accumulated earnings, we call it distribution rather than dividend. However, it is acceptable to refer to a distribution from earnings as a dividend and distribution from capital as liquidating dividend. Okay. More generally, any direct payment by the firm to shareholders may consider a dividend or a part of dividend policy. Dividends come in several different forms. For example, regular cash dividends, extra cash dividends, a special cash dividend, and liquidating dividend. So let me very briefly talk about each of these. First of all, the cash dividends. Um, the most common type of dividend is a cash dividend, right? Commonly, public companies pay regular cash dividends twice a year in Australia and New Zealand, while in the United States, companies tend to pay quarterly dividends. The mid-financial year dividend is called an interim dividend, while the dividend paid at the end of a financial year is called a, a final dividend and is approved at the annual general meeting of the company held after the end of company's financial year. As the name suggests, that these dividends are cash payments made directly to shareholders, and they are made in the ordinary course of business. Okay. In other words, management sees nothing unusual about the dividend and no reason for why it will not be continued. Okay. Now, what about extra cash dividends? Sometimes firm will pay a regular cash dividend and an extra cash dividend. Okay, by calling part of payment extra, management is indicating that the extra part may or may not be repeated in future. Okay, and then a special dividend is similar, but the name usually indicates that this dividend is viewed as a truly unusual or a one-time event, and it will not be repeated. Okay. And finally, the liquidating dividend usually means that some or all of the business has been liquidated or sold off. However, it is leveled a cash dividend payment, reduces a company's cash holdings and also its retained earnings, except in the case of a liquidating dividend. Of course, there are other types of dividends. Companies listed on the Japanese Nikkei stock market have given shareholders alternative dividends in the form of food items, prepaid phone cards, or so forth. Okay. Now, dividend payment chronology. The mechanics of a cash dividend payment can be illustrated by a figure that I can show you here, which is figure 14.1. So you can see that there are different dates. For example, Tuesday, January 15 is declaration date. So declaration date is the date board of directors declares a payment of dividend. Okay. Ex-dividend date, on the other hand, for example, here, which is 31st January, ex-dividend date is a date on which a share goes ex-dividend. Okay. When a share goes in ex-dividend, the seller is entitled to keep the dividend. Okay. Under ASX rules, shares are traded ex-dividend on and after one business day before the record date. Okay. And then February 1 is a record date. The declared dividends are distributed to those who are shareholders of records as of the specific date. And finally, the payment date, for example, here, which is Tuesday, 19 February, payment date at the dividend. Payment date is the date on which dividend checks are directly deposited to bank accounts. Okay. So these are essentially the dates. So let me say a couple of few more points about these dates. So I think declaration date, you are all clear that this is the date on which the board of directors declares that, for example, $1 per share dividend will be paid. Okay. Now, ex-dividend date, to make sure that dividend payments go to the right people, brokerage firms and stock exchanges establish an ex-dividend date. Okay, this date is one business day before the date of record. Okay, so one day before one business day before the date of record. So if you buy the share before this date, you are eligible to the dividend this year. If you buy the share on this date or after, you will not get the dividend. Rather, the previous owner will get the dividend. Okay. So the ex-dividend date essentially removes any ambiguity about who is entitled to the dividend. Okay, since the dividend is valuable, the share price will be affected when the share goes X, because when the share goes on ex-dividend date, it doesn't carry entitlement for dividend. That's why on the ex-dividend date, the share price usually declines by the amount of dividend. Okay. Now, date of record, based on its record, the company prepares a list. Okay, so on the date of record, the company will see who are the shareholders on the company's record date. So they are the holders of record, and the company will pay dividend only to those shareholders who are the owner of the shares on the date of record. Okay. So let's talk a little more about the ex-dividend date. The ex-dividend date is important and is a common source of confusion. So let's talk about what happens to the share when it goes X. So as I already indicated, that when a share goes X, meaning that ex-dividend date arrives. Okay, so to illustrate, suppose that we have a share that is selling at $10. Okay, it is selling at $10. The board of directors declares a dividend of $1 per share, and the record date is Friday, 1 February. Okay, Friday, 1 February. Based on our discussion above, as I indicated, that the share goes X one day before the ex-dividend. So, before the record date. So, if the date of record is February 1st, so ex-dividend date will be one business day earlier, which means that it will be Thursday, 31st January, Thursday, 31st January. So if you buy share, okay, if you buy share on Wednesday, 30th January, just as the market close, you will get the $1 dividend because the share is trading come dividend. Okay. If you wait and buy the share just as the market opens on Thursday, which is the ex-dividend day, then you will not get the $1 dividend. Okay. So for example, this is the ex-dividend date. Okay, ex-dividend day, which is, as I mentioned, the Thursday, 31st January. So if you buy the day before the ex-dividend day, for example, here, which is 30th January, you are entitled to get dividend. However, if you buy on the ex-dividend day or later, you are not entitled to get this year's dividend. Okay. Now, what will happen to the value of the share overnight? If you think about it, the share is obviously worth about $1 less on the ex-dividend date. Okay, so its price will drop by that amount between close of business on the come dividend day and the ex-dividend day. Come dividend day means the day before the ex-dividend day. Okay, so in general, we expect that the value of the share will go down by about the dividend amount when the share goes ex-dividend. Okay, the key word here is about. Since dividends have tax implication, the actual price drop might be close to some measure of the after-tax value of the dividend. Okay, after-tax value of the dividend. For example, you can see here the dividend price, the dividend was $1 and the share price was $10. And when the share goes ex-dividend, so there is about $1. Again, I say about $1 decline in the share price. So the price will be $9. Okay. So just to summarize that, ex-dividend day is the day one day before the record date, and when a share goes ex-dividend, you are no more entitled for this year's dividend, and that's why the share price usually declined by the amount of dividend on ex-dividend day. Okay, and come dividend day, which is the day before the ex-dividend day, if you buy the share, you are entitled for this year's dividend. Okay, so that's the end of our discussion about dividend, different types of dividend, and ex-dividend dates. Okay, in the next video, we will be talking about dividend theories. Thank you very much.